The last time the world saw a shift this big, most people completely missed it, and those who did not, they became millionaires right now. In 2026, something is happening that is going to define the next 20 years of wealth, not next decade, the next 20 years. And I am not talking about one single thing, I am talking about a collision, a massive pileup of economic forces that have never ever happened at the same time. In modern history, the stock market, gold, global trade, artificial intelligence, the United States dollar, all of them moving in a way that textbooks do not even have a chapter for yet. And the scary part is most people are not paying attention at all. So that is what we are doing today. No fluff, just the facts, the raw data, and exactly what it means for your hard-earned money. So make sure to stay until the very end, leave a like, and let us start. Here is the real problem. Most people watch the news, see red numbers flashing on their phone, and feel sick to their stomach, or they see green numbers and feel absolutely amazing. And that is it. That is the entire extent of their financial awareness. They react emotionally to headlines without ever zooming out enough to see what is actually going on beneath the surface. And I get it, the headlines are designed to terrify you or excite you because that is exactly how they get clicks. But let me show you what is happening underneath all the noise, because what is underneath is way more important than any single headline you will read this week. Let me ask you something. Do you know what happened on the 28th of January, 2026? The S&P 500 index crossed 7,000 points for the first time in human history. 7,000 points, this is an index that took nearly 3 full years to go from 4,000 to 5,000 points. Then it went from 5,000 to 6,000 in just 9 months, and then it shot up from 6,000 to 7,000 in only 14 months. The sheer speed of this growth is something we have genuinely never seen before, but here's what I want you to keep in mind as I walk you through everything today. This number 7,000 is not a celebration for everyone. In fact, for most people watching this video right now, this number means absolutely nothing if you are not set up correctly, and being set up correctly is exactly what this video is all about. Because right now we are not just in a standard bull market, we are in a monumental moment of history, and the next 10 to 15 years of your financial life will be shaped in large part by decisions being made right now in 2026. So let me break this down piece by piece. Part 1, the artificial intelligence machine and what it is really doing to the market. Let us start with the S&P 500 and why it is doing what it is doing. That milestone on the 28th of January was not random at all. It happened because of one thing above everything else: artificial intelligence, not the overhyped version of artificial intelligence you have been hearing about for the last few years on social media. I am talking about the real money-making, earnings-generating version of artificial intelligence that is now radically changing what massive corporations are actually worth. Look at the hard data. Microsoft, before the 7,000 breakthrough happened, reported a $281 billion backlog in artificial intelligence-related service contracts. Not future dreams or vague promises, actual binding contracts with actual money locked in. Then Meta announced they are spending more than $115 billion in 2026. Alone on artificial intelligence infrastructure, the 4 biggest technology companies in the world, Alphabet, Amazon, Meta, and Microsoft, are collectively on track to spend $505 billion on artificial intelligence infrastructure just this year. Now, think about what that actually means for a second. That is not money disappearing into thin air. That massive mountain of money flows somewhere into the economy. It flows directly into semiconductors, into data centers, into the specific companies building the actual physical machinery of artificial intelligence. NVIDIA crossed the $5 trillion market capitalization milestone in 2025. Broadcom, Micron, ASML, all of them are seeing historic, unprecedented demand. This is a corporate spending cycle unlike anything we have seen since the interstate highway system was being built back in the day. Except this time, it is happening in a matter of years, not decades, and Goldman Sachs has already raised its year-end 2026 target for the S&P 500 to 7,600 points. JP Morgan has a bull case scenario of 8,000 points. If things play out right over the coming months, these are not small, insignificant numbers, but wait. Here's the critical thing I need you to understand deeply. The S&P 500 hitting 7,000 points does not mean every single part of the markets is healthy. It does not mean your money is automatically safe just because the main index is up, because right now we have what financial analysts are calling a deeply split market on one side. You have technology, artificial intelligence, and semiconductors literally printing money on the other side. You have healthcare companies getting absolutely crushed. Consumer brands are dealing with massive, painful tariff headwinds. Real estate firms are struggling immensely to refinance their massive debts at current rates. Nike had over $1 billion headwind directly from tariffs. Procter & Gamble had to raise prices on 25% of its products because of a $1 billion annual tariff impact. United Health stock dropped nearly 20% in a single trading day, so the index is up. But the index is not the entire market. This is what makes 2026 so incredibly complicated and so important to understand for the average investor. Oh, and by the way, I just opened my free community where I show you how to open your YouTube channel from zero to surviving this economic chaos. There is the link below in the description. Part 2. The trade war nobody fully understood. Now let us talk about tariffs, because this is where things get really interesting. The trade war has been the most significant structural shift in United States trade policy since 1993, not since a few years ago, but literally since 1993. Think about that for a second. The Tax Foundation estimated that the tariffs amount to an average tax increase of $1,500 per United States household in 2026. Last year, it was $1,000. Now it is $1,500. That number is steadily going up. And then on the 20th of February, 2026, something major happened in the legal world. The Supreme Court ruled 6-3 that the International Emergency Economic Powers Act, which was the legal foundation used to impose sweeping tariffs on almost every trading partner, does not actually authorize those tariffs. This immediately changed the entire economic landscape. Overnight, the sweeping general tariffs fell away. Only the Section 232 tariffs, which cover very specific sectors like steel and aluminum, remained fully intact. Now, does that mean the trade war is completely over? Not at all. The administration responded almost immediately with a 10% universal tariff using other available legal tools, but the court ruling removed the biggest and most aggressive pieces of the old tariff structure. And then there's China. China hit back with 34% tariffs of their own. Alongside strict export controls on critical materials, these are measures designed to put real, painful pressure on American businesses that depend heavily on Chinese supply chains. The United States and China trade tension is not going away anytime soon, and pharmaceutical tariffs could easily hit 200% by mid to late 2026. Electronics remain in a confusing gray zone for importers. Here is what this actually means for you and for the broader economy. Companies like GM, Ford, and Toyota, they have all actively started reshoring their operations. They are moving production lines back to the United States to avoid these massive border costs. GM already paid $3.1 billion in tariffs back in 2025. Toyota and Honda are both announcing major plans to increase their United States-based manufacturing capacity. This is a massive structural shift in how global supply chains are built from the ground up. That is a process that takes years to fully complete. And during those transition years, there is friction, there is higher cost, and there is massive economic uncertainty. The Federal Reserve, by the way, cut interest rates 3 times in late 2025, bringing the federal funds rate down to between 3.5% and 3.75%, and markets still confidently expect more rate cuts in 2026. Lower interest rates reduce the cost of borrowing money, which acts as fuel for business investment and corporate growth, but at the very same time, tariffs are actively pushing consumer prices up. So on one hand, you have the Federal Reserve trying to support the economy by making money cheaper, and on the other hand, you have trade policy making things more expensive for everyone. These two powerful forces are pulling in completely opposite directions, and navigating that tension is genuinely one of the hardest challenges for any investor. Right now, part 3, the gold story that almost nobody is talking about on the news. Now, I want to get into something that I think is the most underappreciated part of the current economic picture, and that is gold, because gold right now is doing something it has almost never done in the history of modern finance. Let me give you the raw numbers. Gold closed the year of 2025 up roughly 60% growth in one single year for a defensive asset. The last time gold performed like that was way back in 1979, 1 year earlier. Before 2025, it passed $3,000 an ounce for the first time ever, then it crossed $4,000, then in early January 2026, it briefly touched above $5,600 an ounce. By April 2026, it is sitting around $4,750 to $4,850 an ounce. Even after a healthy pullback from that historic high, JP Morgan is currently forecasting gold averaging $5,055 per ounce by the final quarter of 2026, and longer-term institutional forecasts put $6,000 as a very real possibility. Now, why on earth is this happening? Because there are multiple powerful forces all pushing in the exact same direction at the exact same time. First, central banks around the globe are buying gold at a record-breaking pace. We are talking about over 700 tons of gold purchased in the last 12 months alone by central banks, mainly in emerging market countries, China, Turkey, India, and the Gulf states. They are quietly, steadily moving their massive reserves out of United States Treasury holdings and directly into physical gold. The United States dollar share of global reserves fell from 71% back in 1999 down to around 56 to 57% by 2025. That is a massive historic shift in global finance. Countries are actively diversifying away from the dollar, and gold is exactly where they are going for safety. Second, the United States dollar itself is weakening on the global stage. A weaker dollar naturally makes gold cheaper for foreign buyers using other currencies, which drives more demand and a higher price. It is simple supply and demand math. Third, the geopolitical conflict in early 2026 created massive panic. Iran essentially blocked critical oil traffic through the Strait of Hormuz, which is a vital shipping route that carries roughly 20% of the entire world's oil and natural gas supply. Oil prices spiked dramatically overnight. Inflation fears spiked right along with them, and gold, being the classic safe haven asset during times of geopolitical turmoil, shot up like a rocket. Fourth, Inflation is still a very real problem for the average household. It is not 9% like we saw back in 2022, but the Consumer Price Index in March 2026 is still sitting at 2.9%. It has simply not gone back down to the Federal Reserve's official 2% target, and when everyday people worry that their cash is slowly losing its purchasing power, they buy gold as a proven shield of protection. Now, here is the exact part that most amateur retail investors completely miss. This is not just regular temporary gold demand from panicked retail buyers, this is deep. Structural demand. Central banks are not day traders. They do not buy gold on a whim and then panic sell it 3 months later. When the news changes, they accumulate slowly and hold for decades. And when 40 to 45% of central banks globally are actively planning to increase their gold holdings. According to recent World Gold Council surveys, that creates a massive price floor that is not going to disappear anytime soon. The dollar share of global trade financing and global reserves is on a multi-decade decline that is a slow-moving trend, but it is completely irreversible at this point in history, and gold is the main beneficiary of that shift. Part 4. The real economy versus the market economy here is something I want you to sit with for a moment, because I think this is the single most important idea in this entire video. The stock market is not the real economy. We hear this phrase tossed around all the time, but do we actually understand what it means in 2026? Let me show you the reality. The Magnificent Seven companies, Apple, Microsoft, Nvidia, Meta, Amazon, Alphabet, and Tesla, now account for nearly 35% of the entire S&P 500's market weight. That is a staggering level of corporate concentration we have not seen in many decades. You could easily argue that the S&P 500 is no longer really a realistic picture of the American economy as a whole. It is basically a picture of 7 incredibly powerful technology companies. Meanwhile, on Main Street, things look very different for everyday people. Consumer confidence is under serious pressure. Middle-income shoppers at Target are buying much smaller baskets of goods. Nike's corporate earnings are actively struggling. Walmart is issuing very cautious guidance about a murky, uncertain consumer environment ahead. Real GDP growth in the first quarter of 2026 is trending toward just 2%. That is a significant slowdown from the government spending fueled peaks we saw in 2024 and 2025. So you have a stock market constantly making new all-time highs, and regular people feeling like things are incredibly tight financially. Both of these things are completely true at the exact same time. And this is not a contradiction at all. It is just what an economy looks like when the financial gains are heavily concentrated in very specific technology sectors. Now, why does this matter so much for you and your portfolio? Because if you are positioned in the right part of the market, 2026 is one of the absolute best periods in modern history to be building generational wealth. If you are stuck in the wrong parts, like traditional brick and mortar retail, old school software, or highly leveraged commercial real estate, you are getting absolutely crushed right now. The economic divide is real, and it is widening every single day, and this is where most everyday people make the biggest financial mistake of their lives. They look at the broad market index going up, and they lazily assume their personal money is perfectly fine, or they look at the scary news about tariffs and conflict, and they assume their money is in immediate danger, so they run to cash. Both of those reactions are incredibly lazy. The truth is much more specific and nuanced than either of those simple conclusions. Okay, so here's the part of this video where I want you to stop what you are doing and really focus your attention, because everything I have told you so far, the artificial intelligence spending supercycle, the bitter tariff war, the massive gold surge, the disconnect between the stock market and the real economy, all of it points directly to one inevitable conclusion, and that conclusion is this: we are right in the middle of the largest wealth redistribution event of the last 30 years, not the largest financial crisis, not the literal end of the financial world, but the largest redistribution of capital, meaning wealth is moving rapidly from one set of people and institutions to an entirely different set. It is moving from those who are not paying attention to those who are laser focused. It is moving from those who react emotionally to headlines to those who act strategically based on data. It is moving from those holding the wrong assets to